started, and I think a few more people will be coming in and get some material. So, this is week 4, and excuse me, week 5. This is week 5. Wow, time flies when you're having fun. So week 5, and we have next class, and then we have the exam, which I'll talk about in an hour. We'll talk about it more. So let's review some of the material that we covered today. Let me tell you what we're doing today, and then give you an idea of the material we're going to cover for our one class before the exam. So, Chapter 1 deals with entities subject to income taxation under subchapter J. You all know what an estate is. We're getting different vocabulary words with respect to different trusts, whether they be inter vivos, which are those created during life, testamentary, those created on death. We have irrevocable trusts, those kind of trusts you can't change. We have revocable trusts, those trusts which you can change. We have GST trusts, those trusts are for typically the lifetime of so-called non-skip people. Non-skip people are typically children, and they commonly, GST trusts endure to the benefit of grandchildren. But again, as the semester unfolds, we'll talk more and more. We had a glimpse of a so-called Clifford Trust. Clifford Trusts, if you recall, are those trusts that used to be a little bit more than 10 years. Why were they established? If you recall, prior to 1986, trusts and estates were subject to low income tax rates, so it behooved taxpayers to try to trap money inside a trust or an estate to avail itself of lower tax rates. In fact, next class will be covering a section entitled Trapped Distributions. And again, the psychology is 180 degrees different from what it is today. Today, most people, if they can, prefer the income earned by a trust or an estate to be taxable to the beneficiaries who are generally at lower tax rates than under Code Section 1E. Right? Code Section 1E of the code are the rates for trust and estates, and those rates are generally the highest rates, right? The highest rates being, I believe, somewhere in the year 2016, if you're above essentially $13,000, if you ain't much in the way of income, you're subject to the highest marginal income tax rate for trust. In contrast, most individuals have to be well beyond $200,000 before they're going to be subject to the highest income tax rate. So keep that in mind. 1986 fundamental shift in psychology about who should pay the tax. And remember, a large part of this course is tied up in that issue, right? Who should bear the tax? The beneficiary, the trust, or the estate? Right? So, Chapter 1 deals with some things that might not be, in theory, a trust, but are taxable trusts like life estates, and they go through some other things that we spoke about, but nothing too interesting in Chapter 1. Chapter 2 deals with the entity as a taxpayer, basic principles, and talks about some things in general, how a trust or estate should be taxed under principles most of you are familiar with, Code Section 61, interest taxable under Code Section 61, limitations on interest deductions, Code Section 163(8), right? That personal interest is not deductible. So, for example, if we saw some examples of this where an estate might owe a beneficiary, say, $200,000, and it takes several years to make the payment, and then it pays the person $200,000 plus interest. The interest is certainly taxable to the beneficiary, but the interest is not deductible to the estate. What's my authority? Code Section 163(h). The other item, Chapter 2, that we discussed at length is the deductions under Code Section 212. And Code Section 212 deals with the production of income, deductions relating or expenses incurred with production of income. And we saw that in many instances, unless those expenses are unique to being a trust or an estate, it is subject to the 2% floor. And because of the limitations under Code Section 265, when you compute the amount disallowable, the expenses disallowable relating to tax-exempt income, the production of tax-exempt income, the numerator is the tax-exempt income, and the denominator is taxable income, but it does not include capital gains. It does not include capital gains. We saw that in Manufacturers Hanover. Then we saw permutations of that with respect to other kind of fees that were generated during the lifetime of the trust or the estate. And there we looked at not only capital gains and all income earned, but also unrealized appreciation, if you recall the Fabens case, F-A-B-E-N-S. Okay, so we looked at some of those things. I pointed out to you, and I encourage you over the next 2 weeks, if you could, revisit and take a look again at pages 57, 58, 59. And I've said this virtually every class, but each time we progress ahead, in my opinion, it makes it easier and easier to read back through that material, and hopefully you guys have a better understanding of it. Okay? We talked about the personal exemption. Generally, for an estate, it's $600. For a trust that distributes all of its income, it's $300. And for a complex trust, it's $100. Okay? So there's just some things that you come across in general. Okay. Spoke about the passive activity rules, Code Section 469, and how they apply to estates. We spoke about the fact that the 212 expenses and other expenses, you can deduct them on the estate tax return, that's a Form 706, or on the income tax return, that's a Form 1041, and you can't deduct it on both. That's by authority, Code Section 642G. Then we moved into a discussion about the entity as a conduit, and I said and pointed out, and we're going to see this several times today, we're going to see it several times next class, and we'll go through many examples. I'm going to distribute another Form 1041. We're going to go through a pretty elementary example. But we said that what distinguishes trust and estates from any other legal entity is this notion of D&I. D&I is defined under what code section, guys? And we'll shout at once. Go ahead, Tina, if you're chomping at the bits. 640, right, 643. In general, FISA includes everything but capital gains. Everyone agree? But that doesn't mean it never includes capital gains, right? There are several instances in the regulations, and I told you, you could go through the examples in the regulations, and if you have problems, let me know. I will help you, but many of the examples in the regulations, the D&I did include capital gains, but notwithstanding that the majority of the examples probably it did, it's just misleading, because most cases D&I will not include capital gains. But be forewarned that it's not always the case by any stretch of the imagination. The authors, beginning on chapter 3, talk about the fact where we try to frame the issue that we all know that generally a gift or bequest is not subject to tax under Code Section 102A, right? Back to your days of income tax. Very nostalgic here. But the income earned under trust and estate, okay? The income earned, I should say, on a bequest or gift is subject to tax. So it's my authority, Code Section 101B. So that's the starting point, because if money is placed in a trust or an estate, any income earned, dividends, rent, interest, all that is going to not be sheltered under 102A, but any distribution of principal would be. So how do you get from point A to point B is this concept of D&I, right? Generally, just for the record, so simple trusts are taxable under what code sections?
661.
6 what?
661.
Simple.
651
And
and 652.
yeah. All right. I'm sure this past weekend you were raising this over casual conversation with friends and family. These, I'm sure you were too. And when you talked about complex trust, you spoke about what code sections? 661, 662, right? Right? Good news for your team. This course, unlike some courses, there isn't a myriad of code sections to commit to memory. And again, the exam is open book, but never hurts you writes out to just where to look. Particularly with the big code sections, right? You don't need just this way. You don't have to flip around. You know exactly where to look for hopefully what will be the right answer, right? Right. All right. So you have that framework. The 651 talks about what's deductible. And here there is symmetry. I often in income tax courses point out that sometimes there may be asymmetrical outcomes. That's not the case in this course. The code is designed, right, Rashida? It is designed to give symmetry. What the trust or estate deducts. 652 is designed to pick up correspondingly on the part of the beneficiary. And similarly, that goes to, and we'll see this with respect to complex trusts. 661 and 662 are supposed to operate in unison to create a hermeneutic seal that there's no leakage here of income, that nothing slips through, right? Right. Yeah. All right, so we go through cases. The authors point us to an early case, Harkness, and just to show how D&I operates and to emphasize that in contrast to prior law allowed trusts and estates and the trustee or executor to say, I'm distributing income or I'm distributing principal, not so fast with respect to after 1954. The executor, the trustee, does not have that latitude. Whatever monies come out of the trust or estate will, in proportionate size to the D&I, pick that up, okay, to the beneficiaries. In other words, executors and trustees cannot designate any longer, right? The labels are gone. D&I is immune to that. So we'll see that today. So the authors, we go through, the authors go into detail of how to compute D&I. Often it is a fairly simple computation, but there, of course, our authors are going to give us all the nuances and give us instances when certain conditions are going to be met that D&I will include capital gains. One of the most common of which, of course, is with respect to termination distributions, right? Because often that's going to pull out D&I that includes capital gains, right? So that's one of the most common contexts in which D&I will include capital gains still.
Sorry to jump back a little bit, but can you explain that whole 663C separate shares idea again?
We're going to do that next class.
Okay.
All right,
Yeah,
so
we'll
if
get
you
to
can hold that thought. That's one of the first things we're going to look at for next class.
Okay.
So today's agenda, if everything falls into place, is we will talk about simple trusts and their taxation. And next class, if things fall into place, we will talk about the so-called separate share rule and, in addition, complex trusts.
Right.
Right? And that should bring us right to the point of the midterm. Right, any questions, logistic or otherwise? So, wanted to begin with a discussion. I believe we left off, we had done the problems on page 150, right?
Yes.
149, 150. So, let me just make an observation or two about distributions to beneficiaries. Put section 643C, the authors invite us to read. Entitled beneficiaries includes heir, legatee, devisee. And here, in this case, Dupont Case, and we're on page 150. If you recall, the spouse can elect against the will, right? If your husband or wife disinherits you, under the laws of most states, you can make a claim against the estate. Here, they made an election and they were able to secure, under this state's law, 1/3 of the estate. And picture below, an estate has $3 million. Here the spouse elects to take 1/3 or $1 million, right? And when she gets that distribution from the estate, presumably the estate over its administration has earned income, right? Everyone agree? That the estate during the administration process has earned income. So generally, when an estate makes a distribution, assuming the estate has D&I, and generally if an estate has income, hear what I'm saying? Isn't the starting point for D&I tentative taxable income? So generally an estate that has income will have D&I. And here it's making a significant $1 million distribution. And the estate would like to claim a distribution deduction. And we'll issue a K-1 to the surviving spouse who makes the elective share. And the surviving spouse presumably has to take it into income. This surviving spouse says, no, I don't have income. And we're just beginning on page 150. Keith, do you recall what was this woman's argument and why it wasn't income? Not sure? Yoni? Remember why? Bill?
She essentially said, I opted out. I think there were some provisions for her in the will, but she essentially said, I didn't get it through the will, so I'm not a beneficiary of the estate.
Yeah, she said, look, if you recall, under code sections 652 and 662, right? So
Yes.
those are provisions in which the beneficiary has to pick up income. But the predicate is you're a beneficiary. She said, look, I'm not a beneficiary. I don't have to pick up the income, right? Because I don't fit within the contours of the statute. Does that resonate with the court? And the answer is no. No,
Not at all.
not at all. Okay? Now, let me just point out, and this is something we'll get into more detail in next class, on page 152. In the illustrated material, it says in the Taxpayer Act of 1997, Congress amended 663C to extend the separate share rule to estates as well as trusts. In 1999, the Treasury promulgated regulations clarifying that a surviving spouse's elected share is, in fact, a separate share. So if you take a look, if you could, at this example of the regulation for 1 second, because this comes up a lot in practice. Many people, surviving spouses, elect against the will. So, you could,
And that's usually because they feel that deserve more than they got in the will, or?
Yeah, that's because, who knows, the husband left it to the trophy girlfriend. Okay, so the wife wants to left against. Okay, get the visual? So everyone have example 7 in the regulations? CJ, you got it? You guys find it in the regulations? I'll tell you the page, at least in my version, it's page 1278, but that doesn't help you if you have a different version of the code and regulations. Yeah, we're on page 152. Okay. Everyone have it? It has a fact pattern. Testator dies in 2000 is survived by his spouse and 3 adult children. Testator wills divides the residuary of his estate equally among the 3 children. Notice the wife is not left in the picture. Everyone agree? She a happy camper? No. She files an election under the estate statute. Under the statute, the surviving spouse is entitled to 1/3 of the decedent's estate after the payment of debts and expenses. The statute also provides that the surviving spouse is not entitled to any of the estate's income. It does not participate in its appreciation or depreciation. That's critical. I have that highlighted, that sentence. Why do I have that sentence highlighted? Because picture, if you will, that husband dies, again, the estate is $3 million, and essentially he disinherits his wife. And during the course of the administration, the estate goes up in value. Say that $3,300,000. This goes up about 10%, right? Everyone get the visual? Either it earns interest, dividends, or the like. Under the case we just looked at, remember, the wife is entitled to 1/3 of the estate, but under this state law, which is not uncommon, she's not allowed to participate in the growth of the estate. She can't get 1.1 million, right? And under most state statutes, even if they value the estate decline, she's allowed 1/3 of the date of death value. So even if the estate declines to 2 million, she'd still be entitled to 1 million. Okay? So the executor would have to distribute 1 million. Agreed? And remember, that's a specific amount, right? It's not going to fluctuate. Agreed? And I think, and I'm going to foreshadow something for you guys, that keep your fingers, if you could, on that statute that we're reading from. Okay? Keep your fingers on that. Adrian, we're on page 152, okay? On page, if you look at code section 663, we're going to look at this for next class. It says there shall not be included as amounts falling within 661 or 662, right? So that's regarding complex trust or estates, right? All estates are under 661 and 662, okay, guys? Everyone agree? An estate is never under 651, 652, right? You know how I say that generally distributions pull out D&I? Everyone agree? Distributions generally pull out D&I to the extent there is. However, under 663, there is a major exclusion. It says that any amounts under the terms of the governing instrument is properly paid or credited as a gift or bequest of a specific sum of money or specific property which is paid or credited all at once or in not in more than 3 installments. What this means is, suppose in a will, Jay Sola dies, and I leave $100,000 to everyone in this class, okay? And suppose there's 15 of you, so I'm leaving $1.5 million, and I leave the balance of my estate to my wife, okay? And the rest of my estate is $8.5 million. So my estate's $10 million. I leave you each $100,000, okay? Not too shabby, right? And my estate grows in value it takes 2 to 3 years to administer my estate. And my estate during that 2 or 3 years goes from $10 million to $11 million, okay? Fair? and you each get your $100,000. Okay, before my wife gets anything, you get your $100,000, right? The question is, if the trust has D&I the year that distribution is made to each of you, will K1 be issued to you in which you help pick up a proportion of the D&I? Anthony?
Yes.
Yes? CJ?
Yes.
Yoni?
Yeah.
Lisa, last answer? But guys, no. 663. What I just read to you is that a specific request does not pull out D&I. And it's in the very nature of a Code Section 102A, right? Those two sections sort of dovetail. The notion is, hey, I gave you each $100,000. If you had never set foot in this classroom, and I asked you what were the tax effects, you each would have said no tax. So I feel kind of badly because now you're sitting here and it's distorted all of your income tax, right? Well, you've learned it. But the reality is, 663 works like peanut butter jelly with Code Section 102 to say specific bequests do not pull out D&I, right, David? You see that? And that makes for good exam questions, right? And I'm trying, not only good exam questions, and I say this in a beloved fashion, but in practice you have to know that those kind of specific bequests will not on a 1041 pull out any D&I. But my wife, who gets any distributions, right? She's a residuary beneficiary. She's going to be the benefactor of that growth. That's I said it was going to grow by $1 million, right? How much did I say?
No, $1 million.
The growth. My wife is the winner. Instead of getting 8.5 million, she's going to walk away with 9.5 million, right? Who should be taxed on that million? My wife. Because it would be akin to Code Section 102B, right? She's getting essentially the income on that property, right? Everyone see the visual? See that connection? Easy. Got that? You got it? Yeah? Yes? No? Maybe? Okay, let's go slowly. If I told you I'm going to leave you $100,000, you have taxable income to you. Am I will? Yes? No? The answer is no. Why? Code Section 102, right? Even though it's an accretion to your wealth, Code Section 61 does not apply, right? If I told you you were going to get the income on that $100,000, in other words, I gave Dill a remainder interest, but you were going to get the income on the $100,000, and the income, you would say it's taxable because Code Section 102B specifically says the income on that is not insulated from tax, okay? So taking those precepts and applying them in a case where I died and my estate $10 million, and I bequeath everyone in this room $100,000, okay? So I make in my will a bequest, $100,000 to each of you, and then I say, I devise my bequeath the residuary of my estate to my wife, okay? During the administration of the estate, my estate goes from 10 million to 11 million. There's been growth, right? My estate, that 10 million has been invested, say, in a bank. And somehow, miraculously, we got a nice return, 5% each year. I'm oversimplifying. And it's $11 million at the end of 2 years, okay? Skip the compounding. So, Tina, you get that $100,000. Normally, if the trust has D&I, this trust would, or estate I should say, would have D&I because it has taxable income. Distribution pull out D&I. However, if you look at Code Section 663, it specifically says specific bequests do not pull out D&I. It's an exception. Okay? But my wife, who's a residuary beneficiary, right? So my estate was 10 million. You each get 100,000 or 1.5 million. That leaves 8.5 million plus the $1 million of growth, right? Or 9.5. When that distribution is made, assuming the D9 in the year the distribution is made is 100,000, is 1 million, my wife will get a K1 with that $1 million on it. Okay. Rashida, you got that? Everyone's got that? Important concept, yeah.
Alright, I get that. Question about just the timing of that. Your estate, say it was 2 years, you got your 500,000.
The first year, it would remain taxable 1041.
Okay,
It would the estate would have to bear the tax.
okay,
Year 2, when the distribution was made, the D9 would probably be only 500,000,
got it, okay,
and my wife will only be taxed on 500,000.
okay.
But there's no leakage.
Right, okay.
Okay,
That's what I was gonna-
great question.
Right.
Completely understand why you asked. Everyone see, it's during the 2-year process, if there's no distribution to my wife in year 1, hey, that money remains trapped, that's a common term of art in this world, subchapter J, remains trapped in the estate, it will pay the tax.
Okay.
All right? So I was just reading to you example 7, that was a digression, where this surviving spouse elected against the will, and she's only allowed a strict 1/3. It says, however, under the statute, the surviving spouse is entitled to interest in the elective share from the date the court directed the payment till the executor actually makes the payment. During the estate's 2001 taxable year, the estate distributes to the surviving spouse $5 million in partial satisfaction of the elective share and pays $200,000 of interest in the delayed payment of the elective share. During that year, the estate receives dividend income of $3 million and pays expenses of $60 that are deductible on the estate's federal tax return. So, picture, if you will, you recall that I gave each one of you $100,000. Agreed?
Yes.
And the executor, for a lot of different reasons, doesn't make distributions to you for 2 years. There's legitimate reasons. They couldn't get a closing letter from the state of New Jersey or federal after they filed the estate tax returns. So it takes 2 years. And under New Jersey statutes, after the first 6 months, if you're not paid your specific request, you're allowed interest payments on your $100,000 that I bequeathed you. So you may end up with not just $100,000, you may end up with $105,000. Okay, everyone agree? So the question is, will that $5,000 pull out D&I? Will that $5,000 pull out D&I? Instincts, David? Yes, no?
Yes.
You think so, right? You think so. Everyone think so? I would think so. But when you get paid that $5,000, are you being paid as a beneficiary? Or are you really a creditor to the estate? Isn't that owed to you because there's a debt under state law that the estate owes you? You're really not being paid that as a beneficiary. And therefore, it does not pull out D&I. You're still taxed under Code Section 61. It's an interest payment, right? But it's not deductible to the estate. What's my authority? Code Section 163H. Because personal interest is not deductible. Ever got that? It's not intuitive. So David, if you don't get mad at yourself, it's not intuitive. All right? But if you keep reading here, conclusion says the estate has 4 separate shares, and Bill will like this because it's talking indirectly about the separate share rule under Code Section 663C, consisting of the surviving spouse's elective share and each of the 3 children's residuary bequests. Because the surviving spouse is not entitled to any estate income under state law, none of the estate's gross income is allocable to the spouse under the separate share for purposes of determining the shares D&I. Therefore, with respect to the $5 million distribution, the estate is allowed no deduction under 661. Again, it doesn't pull out any D&I. No amount is includable in the spouse's income under 662. The $200,000 in interest paid to the spouse must be included in the spouse's gross income under 61. No surprise there. Because no distributions were made to any other beneficiaries during the year, there's no need to compute the D&I for the 3 other separate shares. Thus, the taxable income of the estate is, and it goes through a figure, the dividend income minus the expenses and the personal exemption. the estate's $200,000 of interest payment is non-deductible under 163H. All right, see that? All right. We have the Dupont case. Now, talking about a case that doesn't die, no pun intended. This is it. This gets back to, if you recall, Mrs. Dupont was seeking to deduct the maintenance expenses associated with her house under Code Section 212.2. And if you recall the earlier case on page 37, that did not apply. The court said it was not deductible. Here, if you recall, it was not argued at the time, but the trustees raised it too late, but now they're doing it on appeal, saying, look, okay, maybe it's not deductible, but it should have been under 212, but it should have been deducted under Code Section 661. And yes, it should have been included in her income under 662. Now, you know and I know, here there would be real leakage, right? Because the trust wants a deduction. And what about Mrs. Dupont? I mean, those tax years have long been closed, right, under the statute of limitations. So apparently the trust years are still open for deduction. But Mrs. Dupont and her 1040s have long been buried, okay? So they're just looking for deduction, saying, look, it's her business if she included an income, but we should get a deduction because whatever maintenance fees were incurred here were indirectly distributions to her. Okay, everyone had a visual? In the regulations, it makes clear that whether the distributions are direct or indirect, they should be picked up in income to the beneficiaries, direct or indirect. So they're saying, look, when those blades of grass were cut, she was the indirect beneficiaries. And when all this maintenance work was done on the premises, she was the indirect beneficiary, and as such, she should have picked up these as distributions. All right? Was that effective? At the end of the day, was it effective? Remember, guys, and just quick history, because you may not remember from weeks ago when we covered the Dupont case. What do you want to call it? Bastion. I mean, if you, again, I don't think any of you have been down there. If you get a chance, it's a beautiful place. Fall foliage in a few weeks. It'll be a little later than here because it's in Delaware, but if you can, you haven't even been down there? You ever been down there? Get a chance, check it out on the internet, but it's pretty spectacular. Anyway, it was built in 1910. It was originally owned by a corporation. They transferred it to the corporation, or some funky tax deals that I'm not quite sure anyone can make out 100 years later. The husband died in 1935, so this is long ago. And this relates to expenditures made in 1966 and 1967, where each of those years the trust spent essentially $250,000 a year to maintain the premises. Okay? So, in this case, well, the tax court, and then it's been affirmed by the Fifth Circuit, will allow a deduction for quote-unquote indirect benefit made to Mrs. Dupont. And the answer is, you recall Anthony? Artura, Adrian? Artura? Mom, you get there? Everyone's gearing up for October 15th, maybe? They held that it was not deductible, okay? Now, they had some funky, this is two different arguments the court makes to hold in favor of the IRS. The first argument is that, and this is really oblique, it's hard to follow, is that somehow when the corporation was liquidated, the trust had contractually obligated itself to maintain the premises. So let me repeat that. If you look on page 154, the second full paragraph on page 154, accordingly, even if the payments here are an issue regarding having been made primarily for Mrs. Dupont's benefit, she received the benefit thereof not as a beneficiary. Remember, that's critical, right? Under 652 or 662 for the testamentary trust, but rather as a result of contractual arrangement with Mars Inc., that's the corporation, a long ago prior to Mr. Dupont's death. So that there was some sort of loose contractual arrangement. Now, I have to tell you, it's kind of weird because this contractual arrangement, I'm not sure what really happened or didn't happen 3 or 4 decades earlier that this so-called contractual arrangement. It's never, I think, made clear to us. I'm not sure why the court would have, at least the court didn't articulate a clear reason why there was a contractual obligation here, and I can't do it either. But the court, though, has a second reason for why she was not an indirect beneficiary. And the rationale is, why did Mr. Dupont set this up? Why did Mr. Dupont set it up? Did he have this arrangement? Was this property really being maintained for Mrs. Dupont's enjoyment? And the court said, look, as a practical reality during the years in question, Mrs. Dupont was more or less an invalid, okay? She could barely enjoy anything on the premises, right? She, I think, was, essentially was sequestered to the living arrangement and could not see, any of the work. Why? Why was the trust maintaining this property? The notion was Mr. Dupont sort of wanted to perpetuate his name and leave this really to his ancestors. It was not really to benefit Mrs. No offense to her. That was not high in his agenda. And that being the case, it was really to sustain this property as more of a memorial to him than anything else. She was, yeah, she benefited, but it wasn't in a meaningful sense, and the court says, as such, certainly the fees incurred. This was significant fees, right? Everyone agree? During the tax years in question, this is several millions of dollars of maintenance fees, the equivalent in 2016 dollars. She wasn't enjoying the benefits of those. Right? So, court rules that this was not a distribution to a beneficiary. Okay? So, if there's symmetry here, she would have had to pick it up in income. But the practical reality is trust is not allowed deduction. Again, if the tax years hadn't been closed, she would have had to pick it up in income, but not in these circumstances. Does this kind of issue come up a lot in practice, guys? So you're going to see a lot of cases like this? The answer is categorically no. Why do the authors have it in the textbook? Again, one reason is there's not a lot of case law, okay? This is, when it comes to 1041s, they're probably one of the least audited returns out there, I keep telling you that. So there's not much the authors can offer you, but it is giving you sort of an overview of who and when constitutes a beneficiary, okay? In the material that follows, it talks about circumstances when sometimes people will qualify as a beneficiary, when they won't. And they talk, for example, if you have a contractual obligation, you're not going to be a beneficiary, right? Contractual obligations are not in the traditional word of being a beneficiary. Contractual obligations. We just saw on the bottom of page 156, 157, that interest payments you're not a beneficiary, you're treated as a creditor. And there's different things that the author spelled out here of when people are beneficiaries and when they're not. So we don't need to go into depth on those, they don't come up too often. Let's talk about simple trust. All right. So let's just make some observations about simple trust. The easiest being in this world, subchapter J's world, there's only two kinds of trust for our purposes. I mean, there's actually more, and we're going to see this in 3 or 4 weeks when we talk about grantor trust. But right now, for the moment, your world is it a simple trust or is it a complex trust? And the definition of a simple trust is spelled out, Code Section 651A. We spoke about this in prior classes. It has to meet 3 requirements. Trust must require all income be distributed currently. That's condition 1. Condition 2 is the trust must not, emphasis on the word not, provide that any amounts may be paid, permanently set aside, or used in the taxable year for charitable purposes. And condition 3 is the trust does not, in all caps the word not, does not make any distributions other than income distributions. So there could be no principal distributions. If the trust doesn't meet those 3 conditions, it's conjunctive, it must meet all 3. By default, it's a complex trust. Where does an estate fall? As I said to you before, essentially under Regulation 651A-5, the estate says, that regulation essentially says, an estate shall always be treated as a complex trust. Why? Because every estate I've ever met, there's never a requirement that income be distributed. Okay, what if a will does require an estate to distribute income and does not make any principal distributions? So, in theory, it looks like it should be treated as a simple trust, but the regulations still say, even if it seems to meet all 3 conditions, treat it as a complex trust, which is not that important because as a practical matter, you'll get to the same end result on the 1041 and on the K1. So it's not a make or break kind of, you'll just check off the different boxes on the top of the 1041. Let's talk more details about each one of these conditions. When we say that required income distribution, what does that mean? What does income? Well, let me just emphasize this. I think you guys know this, but just doesn't hurt repeating. Income refers to fiduciary accounting income, right? Fiduciary accounting income. It does not refer to taxable income under the code. It refers to fiduciary accounting income. Let me just make an observation or two. If the trustee is directed to set aside a reserve for depreciation, so picture PL, the trustee is supposed to set aside a reserve for depreciation, the beneficiary will receive less income, true, right? Because the reserve has been set up. A portion of the income will be allocable to the trust, and the trust will also receive a portion of any depreciation allowance. Is that a simple trust or a complex trust? And the answer is it's still a simple trust since all the income for trust accounting purposes must be distributed. So even if there's a reserve, as long as all the trust accounting income must be distributed, it's still a simple trust. How do we know the word income means fiduciary accounting income? If you look at regulation 643B-1, I'll repeat, 643B-1 says, income when not preceded by the words taxable, distributable net, undistributable net, or gross means the amount of income of an estate or trust for the taxable year determined under the terms of its governing instrument and applicable local law. In other words, guys, translate that it means fiduciary accounting income under the Uniform Principal and Income Act. Okay? Under state law, how is income defined? You know, determining income before year's end is not always easy. Right? Everyone agree? That determining the amount of trust earned in income is not always easy. And we'll see soon there's something called a 65-day rule that as long as you make a distribution within the first 65 days at the end of the trust, the end of the trust year or the estate year, you can elect to treat it as if it were made during that year. Right? Everyone agree? Because it's very hard to know what a trust has in income until after the fact, right? Until after the last day of the taxable year, but there is this 65-day rule. So let me just raise the question, what would be the result if a trust directed the trustee to distribute trust income in the year following its receipt? So there is a direction in the trust instrument to always distribute trust income the year after its receipt. Would that be a simple trust? No. You must say it's currently distributed. You can't say distribute the year after. There is already an allowance made in the code to relate back, but you can't have that provision. That would be a complex trust.
If it's made in the 65 days after the year ends.
That's okay.
Okay.
But you can't have a trust provision say that. You see what I'm saying? It should say simply all income should be distributed current. That works. But if you say it should be distributed to the prior year, that doesn't work. Does it matter if the beneficiaries are known or unknown? Must the income be distributed to known beneficiaries? Can the trustee, in other words, have a sprinkling power to distribute to the testator's children as the trustee sees fit? The answer is yes. In other words, as long as all the income can be distributed, and the trust says, all income currently distributed to my children as the trustee determines, okay? So I have 3 children, A, B, and C. Even though it's not clear who's going to get all the income, some of the income, or none of the income, as long as it must all be distributed, it will be a simple trust. There can be no distribution of forfeits, right? No distribution of principal. So if I have a trust that permits my trustee to make distributions of forfeits, right? I give my trustee permission, but he or she or it doesn't exercise it, then it still would be a simple trust, right? Right, Jenny? In other words, I could give permission, and during the course of that year, if they don't exercise that discretion, that works. How about if the trustee had discretion to distribute income and principal for the beneficiary's health, maintenance, support in the year in question, and the trustee distributes all the income but no principal? I'll repeat. What if trustee had discretion to distribute income and principal for the beneficiary's health, maintenance, support, and the trustee distributes all the income but no principal? Is that a simple trust? Complex trust. Jenny? Simple. Lisa? Simple. Jody?
Simple.
CJ? It ain't simple. Why? It's not required. The trustee had the discretion to distribute income and principal, right? Everyone agree? The fact he or she or it exercised the discretion doesn't make it into a simple trust, right? It must be required that the income be distributed, right? CJ? I'm not trying to be hard time, and you might get to the same answer, just different box checked off, so maybe the personal exemption might be a bit different, depending on certain. But you never know when that may play a role. Just make the observation, I've said it 2 or 3 occasions, maybe 4 or 5. What happens to a simple trust in the year of termination? Well, in that case, there's always going to be principal distributions. We know it's going to be transformative into a complex trust. We know there can be no charitable distributions. Okay? If there are, it's not a simple trust. Okay? So what happens if you have a trust paid to Zhao's Life for life, and then it passes to Rutgers? Okay? Trust pays income each year, required to Zhao, and then it passes to Rutgers. In that case, is it a simple trust? Zhao, what do you think?
Goes to me and then goes to Rutgers.
So in the current year, is it a simple trust or a complex trust?
It's complex trust.
Why do you say complex? In 2016, you're not dead yet.
Okay.
So the answer is now simple. Because it's only in the current year you look, and as long as there's no distributions made to the charity in the current year, it's still a simple trust. Okay?
So the Rutgers is a charitable.
It is, but you're not dead.
Oh, okay, because I'm still alive.
Good news.
Yeah, always.
Right? It doesn't matter if the income is actually distributed, it just must be required to be distributed. Okay? It doesn't, we'll get into that when we look at some of the cases. So whether or not it's distributed, it still would constitute a simple trust. Okay? So there's just some, quick down and dirty attributes of a simple trust. So you guys, if you walk into one, you'll know it, right? You can introduce yourselves. And again, if it's not simple, it's complex. That's good news. So as long as you know one, you'll know the other, at least if you know the simple. All right. So there's several cases here. The Seligson case, the commissioner, fairly recent case. Here we have the disgruntled son case. Why do they say disgruntled son case? It's because the father set up a trust for son, and son was estranged from dad, and he didn't want to get the income from the trust. Was it a simple trust? If you look on page 159, the second to last paragraph, or Article 9, paragraph A, says, during the lifetime of my son, my trustee shall pay to him, apply for his benefit, the entire net income in quarter, annual, or more frequent installments as may be convenient to my trustee. Does everyone see that? Simple, right? Generic, simple, that's the language I and other people use all the time. But remember, he's not taking any of this. And he did not file what's called a disclaimer saying, where he really severs his interest in the property. He's essentially saying, I don't want it, don't give it to me. Nevertheless, is he going to be taxed on it, even though he physically did not take it? He kept telling the trustee, I just hold on to it. And taxpayer taxed on this, meaning the son, and the answer is yes. Okay? So even though there were no distributions of principal, there was no distribution of income, it's still a simple trust. Again, it met all three conditions. So he's going to get taxed on it. Just call to your attention once again on page 162. Item 3, I have highlighted in red. Item 3 on that page. 651A allows the deduction for income, quote unquote, required to be distributed currently. And 652A subjects the beneficiary to taxation amounts, quote unquote, required to be distributed whether distributed or not. Go down one more sentence. It says, since the beneficiary is entitled to the income, the beneficiary can force the trustee to pay him or her the income in question, notwithstanding the prior erroneous distribution. Well, I'm just going to make a point to you. Most of you have had income tax, right? And there was a case that you may or may not remember, fairly famous case, North American Oil. If you remember the North American Oil case, it stands for a simple proposition. That if you have a claim of right, you may recall the claim of right document, a claim of right to property where you can get the income in this case. The courts have ruled that claim of right gives rise to taxable income, right? Because you, even though you don't physically have it, you have a claim to it, it's yours. If you're not exercising your right, that's your business. But if you have a claim to it, and it's a legitimate claim, you should be taxed. Go.
Not to throw another monkey wrench into this, but so the son was taxed on the income that was required to be distributed out, but he didn't actually take any of it. So the trustee does what with the income? Just adds it.
Probably kept it, but probably deducted it on the 1031.
So say trustee keeps it and reinvests it or something like that. Mm-hmm. Is the income on that?
Absolutely taxable.
Okay.
To me, what's going on here, I don't know who the remainder beneficiaries are. I'm going to guess it's the son's children.
I think it said it was a daughter. They all went to the daughter.
Really?
Yeah, I think so.
And that's strange. I mean, usually I say the issue per stirpe, so it'll go to the son.
On the death of his son, remaining principal of the trust, together with all accrued and undistributed income, shall be disposed pursuant to blah, 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 blah.
Where are you reading from?
Page 160.
Okay, 1 second. Okay, I'll tell you what paragraph 8 says. One. Right. Interesting. I would never have done this. I mean, he must have really had it in for his son, because usually people may not get along with their children. I've seen this all the time. But what they end up doing is they then say, well, their offspring will be better. So they leave it to the grandchildren. You know, so it's surprising that the father here bypassed. Anyway, I can't answer that. I'm just telling you what most people do. And to me, it's almost like if I'm the IRS, he has a risk of making taxable gifts to the trust. Because when you don't take the money, and it doesn't qualify for present interest exclusions under 2503B.
Sure.
So I would think he would have to should be filing if the numbers were significant here, gift tax returns.
Oh, that's messy.
It would be messy.
Okay.
So he should be taking the money. All right? Screw the father. Take the money. Right? Anything else? You guys good? Mildred. Another interesting case. What do I mean by interesting? Quick fact pattern here. We have Mildred, was adopted by Philip. Okay, everyone get the visual? Mildred is adopted by Philip back in 1912. In 1922, Philip's uncle establishes a trust. Okay, everyone got that? Picture, if you will, you adopted Mildred, each one of you, and your uncle is going to set up a trust for himself. Where he gets income for life. Then he leaves income to each of you. You're his nieces and nephews, okay? Including Philip. So picture each of you are going to get income, okay? And then upon your demise, which is very unusual, it goes to your spouses. You're not bloodline, so it's very unusual in my world to see that. And then it goes to income to the children of the nieces and nephews, income to the issue of the nieces and nephews. And on the last niece and nephew, on the death of the last niece and nephew, to be divided among the surviving lawful issue of the bodies of the nieces and nephews. So on one hand, whoever drafted this said the income shall go to the issue of the nieces and nephews. He uses the word issue. And when the final distribution is going to be made, it must go to, quote unquote, the lawful issue of the bodies. Now, was this intentional on the part of the draftsperson, or was this just sloppy drafting? Guess what? We'll never know. Okay? But the point is, Mildred was legally adopted, and if I recall correctly, she was mentally incompetent, okay? So she's mentally incompetent. And let me just, some other years in question. 1940, Philip dies. So income goes to his spouse. Okay, so picture, if you will, Philip's a nephew. He dies in 1940. And the income is now supposed to go to his spouse. 9 years later, his wife Elizabeth dies. So there's a suit instituted at the local court level to see if Mildred, in 1952, if Mildred is entitled to the income. Is Mildred entitled to the income from this trust? Okay? What's decided here? That Mildred was entitled to the income. She died a few years later, but that she was entitled to the income from the trust. But on the death of the last of the nieces and nephews, she was not a lawful body. Okay? That she wouldn't be entitled to any of the principal. So it was decided that she was entitled to the income during her life, but not any to the principal. So the IRS says, look, the trust mandates the payment of income. Right? Everyone agree? Requires income payment. And no payments to charity, no principal distribution. It has the aroma of what? I know what you're all thinking. A simple trust, right? Code section 651, 652. Right, so? Right. Okay? And we looked at, and there is existing case law, lots of it, for the proposition that, hey, even if you don't take it, you should be taxable on it. But that's kind of harsh treatment here, right, guys? Because admittedly, Mildred's incompetent, but putting that issue aside, would you like to be a beneficiary where whether or not you get the money is up to question, right? Because it's going to court whether or not you're legally entitled. Meanwhile, would you want to pay taxes beginning in 1949? It's going to take several years for a state court to determine whether or not you're legally entitled to it. On monies you're not even getting. Do you see what I'm saying?
Especially if you end up not
I
getting
mean,
it
it's
all.
one thing in Seglinson when you say, oh, don't pay me. Okay, that's a big difference from that compared to you're not physically getting the money, you can't get the money, right? Because, and this court says you should be taxed on it. I mean, it is the law, but you can see it can create a certain harshness to it. I could see this case being overturned at some point because, you know, the inequities seem, when you read the dissent here, guys, it says it violates the claim of right doctrine. The cash method taxpayer doesn't get the cash. I think the authors of our textbook highlighted or kept in the dissent, where many times the authors of our textbook might jettison the dissent. Here, I think the authors purposely kept in the dissent because it's a pretty compelling dissent. We got to feel our hearts have to go out for Mildred, right? But ultimately, she does not prevail, right? So we also have to live with that reality.
If she was taxable, then she should have entitled to the money.
Well, there's a difference. I mean, remember, state court is different from federal. So the feds say you got to pay tax. The state court, that was left open. And she could have paid the tax. And what happens if the state court ruled the other way against her? And it would have been hard for her to keep the statute of limitations open to get a refund. So really puts her in a very, very awkward position that unenviable comes to mind, okay? So just, you know, read this if you get a chance and take a look at the dissent, because the dissent does not paint a pretty picture here of what could happen or should happen. All right? We have a revenue rule, 85-116. I mean, what's the takeaway of this revenue ruling? Now, truth be told, this deals with something that you're not going to come up and see too often. If you look up page 169, the third full paragraph on the revenue ruling, 85-116, there's a strange provision under local law that it imputes a return on what are known as unproductive assets. This is to protect current beneficiaries that if something has, if a trust holds unproductive assets, it's going to impute a rate of return. Let me just point out a reality. I've done enough work for the last 20, 25 years in this area. If you're a fiduciary, are you going to invest in unproductive assets, guys?
I hope not.
What?
So I hope not.
You would hope not, right? You're going to try to maximize, right, your return. It's very unusual. I mean, once in a while you'll do it because it's a family business and the trust specifically says you can retain investments in something akin to this. I don't think we want to spend too much time in looking at something that is really obscure and you're not going to see either on the exam or in practice. So you can look at Revenue Rule 85-116. It has some basic principles spelled out before the analysis, but it's not something that you really need to belabor because you're not going to see anything like this for exam purposes. Okay? I will point out, though, it does deal with a simple trust. It deals with a simple trust. That even if it's simple, a component of it can be comprised of capital gains. Okay? I'll repeat. There is no principal distribution no principal distribution here, but because the uniqueness of the facts here, part of the D&I was comprised of capital gains, but that's unusual. Not gonna happen too much. Okay. Okay, let me make some other observation in the material that follows. When must the income beneficiary report the income? When must the beneficiary report the income that she or it receives if you're a beneficiary? The amount is based on the amount of the trust income for the year ending within or with the taxpayer. So this is under section 652C. If you have 652C. The taxable year of the beneficiary is different from that of the trust. The amount which the beneficiary is required to include in gross income in accordance with the provisions of this section will be based on the amount of income of the trust for any taxable year or years of the trust ending within or with his taxable year, meaning the beneficiary's taxable year. And you'll see the analyze on that. You look at 662C, same thing. So if an estate, if the taxable year of an estate ends in January of, say, 2017, if the estate, the taxable year of an estate ends in January of 2017, you can report that income on your 2017 tax return, okay? I will point out, so that taxpayers don't play games like they used to, look at code section 644. For the purpose of this title, the taxable year of any trust shall be the calendar year. That's a change from part of 86. 1986, that Congress mandates that all trusts be on a calendar year so that people couldn't gain deferral. Estates can still be on a fiscal year. Right? Estates, you can choose what year you're going to use. And because the states don't have to pay estimated tax for the first 2 years, there can be some real deferral savings possible. Don't worry, there's some discussion of loss of citizenship rules and things like that. I'm not going to ask you obscure questions relating to loss of citizenship and things like that. Just want to remind people what a disclaimer does. Generally, just so you know, a disclaimer, I tell clients that the disclaimer is usually a 1 or 2 page document. Someone dies or someone makes you a gift. You have no legal obligation, and you must accept a gift or request. So you could, within 9 months of the person dying, file what's called a disclaimer, where essentially you declare to the world. You have to file with the surrogate court where the person died, and you say, I don't want the gift, I don't want the request. And what ends up happening is you're treated as if you predeceased the decedent. So it's as if it's a non-event to you. So if you file a disclaimer, that's a way to shed whatever was given you. We have one more revenue ruling, 74-257. And this relates back to something you learned in Manufacturers Hanover. In the revenue ruling, it says the first source for the issue. Advice has been requested whether a trust may be allowed a deduction for state income taxes if paid as a result of capital gains retained by the trust in accordance with the terms of its governing instrument for the benefit of a non-charitable remainderment under the circumstances described below. Now let me just make an observation or two. if you have a capital gain, generally it's not part of D&I, right?
Right.
Generally there's going to be tax owed on it, and including not only federal tax, but state. Say the state of New Jersey is going to collect its fair share of tax, right? Are those taxes deductible? Sure. What code section? 164, right? You're allowed a deduction. Even though the capital gain is going to inure to the benefit of whom? The remainder beneficiaries, right? Because principal distributions are ultimately, right, in my hypothetical trust, going to pass, right, Rashida, to the remainder beneficiaries. So the capital gains, if you're a remainder beneficiary of those capital gains, ultimately you're going to inure to your benefit, okay? Having said that, the state tax that has to be paid today is deductible. Who's that going to help? The remainder beneficiaries or the current beneficiaries? It's going to help the current beneficiaries, right? Because it's going to be deductible, and as a result of the deduction, is D&I going to go up or down? Down, right? Because D&I is based, at least initially, on your taxable income. This is going to reduce taxable income. If it reduces taxable income, it's going to reduce D&I. If it reduces D&I, that reduces the ceiling amount, right, that you can be taxed on. So that's the takeaway of this revenue rule.